We have breaking news from Bloomberg in which Mondelez are looking to take over Hershey, and this isn't the first time that they have tried to do this. In fact, there was talks in 2016 where they were trying to pay around $23 billion, which was ultimately rejected. Now, off the back of that, this company is up around 12%. It is the one that I have sold out of given the gain, and we can see, in fact, it was as high as $208. That was a 20% pop off the back of this news. Now, I'm going to explain why I've sold out of this company. We're also going to take a look at Mondelez, which is down around 2% in relation to this news. And towards the end of the episode, I am going to cover the two companies that I am buying with the Hershey funds. Now, first thing to note for those that are fairly new to this company, Hershey essentially produces and sells a variety of chocolate as well as candy and snack products, and there are some very large, very well-known brands. You have Reese's, Kit Kats, as well as Hershey's own Kisses. On the other hand, we have Mondelez, again, very well-known global snack company. They produce some very large popular brands. You have Oreo, Cadbury, Toblerone, as well as Ritz, and then it does make sense as to why these companies may want to come together with one acquiring the other. Now, if we take a look back at the Hershey company, over the last 12 months, it is down around 6%. In fact, if you've been a longer term shareholder, you would be up around 99%. In fact, we can see all-time highs did sit around $275, and we're talking around a year and a half ago. Now it trades at the upper end of the 52-week range. We get one buy rating with both Wall Street and Quant giving this a hold, and it does currently offer a 3.14% yield and a forward P that is well below the S&P at 19.3. So first thing that we're going to talk about here is a little bit rare, not something we typically see on this channel, that is institutional ownership, and there is a massive gap in terms of the buys and sells. First things first, the ownership itself sits at 58%. In terms of sales, well, 12 billion was sold over the last year, and during the same time frame, we actually have a lot less buying. That is a very rare occasion on this channel. Regular viewers will know 9 times out of 10, institutions typically buy more shares than they do sell. If we do look at the more recent quarter though, we do notice just a marginal amount more of buys than they have been selling. And whilst we are sharing this information, of course, this shouldn't be a reason why you do buy or why you do sell any company. In terms of the actual metrics at a very high level, we do get a dividend safety score of 80. We also get undervaluation based on the yield. Now, given the price increase today, it has dropped below 3% to 2.81. In terms of on the forward P, again, we are going to run it through our own valuation model just to highlight, but this shows reasonable valuation. And this is a company that is very typical in terms of their increases at double digits, and we do notice 15% in February this year. Now, the first reason why we have sold this company is that they do get a D- in terms of the growth grade, and the companies that we have put our money into instead of this company have a lot better prospects in terms of growth moving forwards. Although we do understand this company over the last few years has been struggling with the increase in the cocoa prices, which is one of their ingredients. It does hit their cost of sales, impacting both their top line, as essentially they're charging more to consumers for their products. In turn, consumers will buy less, and their margins also get hampered. Now, in terms of what they're estimating, well, actually, over the next 3 to 5 years, Hershey is anticipating negative 4.4% decrease year on year to their earnings per share. The sector as a whole, 7.53%. Now, we will run through this information from Mondelez, which actually we have a different story to be told. But as we pointed out, the growth story for Hershey itself isn't looking too good. And this is something that is also reflected in the share price. As always, on this channel, we do run through our valuation for each of these companies. Now, we just want to show you at the high level, as we have covered this not too long ago, our intrinsic value does sit at $203. The current price after the pop today, right now, even though it was higher, sits at 195, which indicates, as we'll show you, a very small margin of safety. Typically, we use 10% on this channel, and we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data, which is pretty obvious. Hershey doesn't hit all three of those. So even though we would need more than a 10% MOS, at 183, that is where it would be for that level of conviction, telling us right now it isn't a buy because it doesn't even hold the 5% MOS. So we do believe right now this company isn't trading too far off its own intrinsic value, giving limited upside moving forwards, limited discount to buying the company, and we can also see Wall Street themselves, based on this current movement in price, now see no upside over the next 12 months. So just running for a quick conclusion why we've sold this company: lack of growth over the long term. The increase to the share price today has indicated that the MOS is very, very small and the upside is incredibly limited if you do essentially take a look at Wall Street and use some of their estimations in your own thesis. Now bear in mind, it isn't a bad company at all to have in your own portfolio, but we want to start moving away from these companies where there is a lack of growth and into ones that we do believe over the long term, as we will come to show you with our buy selections, can offer exactly that. Now before we jump into Mondelez and the companies we're buying, we just want to let you know this morning we've released our free weekly article talking about the one stock we are buying heavily in December. Remember, you can grab a copy by clicking on the pinned comment below, signing up and reading these, and we send them every Monday morning to your inbox. We highlight significantly undervalued stocks for your attention, as well as what's gone in the market over the last few days. And on top of that, you can grab our copy of December's undervalued dividend stocks, 28 of them, lots of information, the upside that Wall Street themselves see over the next year, and you can also grab 29 undervalued stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and start reading straight away. Now very briefly, similar to how we looked at for Hershey's, we're just going to take a look at Mondelez. Now first thing to note, it is trading after the 2.5% drop today, right there at its 52-week low. We get a strong buy from Wall Street where we saw them have a hold with Hershey's, Quant still giving this company a hold, and Seeking Alpha giving this a buy. In terms of the yield, well, it sits around 3%, marginally higher than Hershey, around the similar forward P at 18, and over the last 12 months, again, the same issues that we highlighted with Hershey Company, Mondelez also faces. Over the last 10 years as well, up around 64%, but again, something we didn't mention, both companies have underperformed the S&P over the last 10. When we take a look at this company in terms of institutions, well, we get 78% ownership, around 4.65 billion worth of sales over the last year. But unlike Hershey, we see more buying, significantly more buying over the same time frame. In fact, in Q3 as well, we do get a lot more buying than selling, quite a significant distance. Therefore telling us that institutions over the last year and in the more recent quarter are very bullish on Mondelez, not something we could conclude with the Hershey Company. In terms of very quickly looking at these metrics, we get a dividend safety score of 66, lower than Hershey, still indicating safety. A severe undervaluation signal here, as we can see the yield above the 5-year average, as well as being the highest yield they've offered over the last 5 years. In terms of valuation, we also note it does look towards the lower end of reasonable valuation, so possible undervaluation, with a very attractive double-digit increase in August 24, although we did note that from Hershey as well. In terms of looking at their growth, again, very similar in nature to Hershey, not the greatest at a C. In fact, their earnings per share over the next 3 to 5 years is a D+, but the one thing we can say, it is positive at 5%, whereas Hershey's was negative, and that is marginally lower than the sector median of 7.53. So you have two companies that, one, you have a lack of growth, the other one, there is growth, but not as much as the sector overall. However, as we are going to show you now, with Mondelez, we do see a nice margin of safety, as well as some very nice upside over the next 12 months. We also want to point out, if you do enjoy these episodes, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of $81, pretty much in line with Wall Street, who see a 33% upside just into the next year. In terms of MOS, we'll at 10% a buy at $73, at 20% around $65, and in today's episode at around $61, we see Mondelez with 25% MOS and 33% upside. Now, we do believe this does look like a fairly decent buy if this company does fit your overall portfolio, but as always, you need to do your own due diligence to consider whether or not you want exposure to this company, to this industry. However, having said that, for full disclosure, this isn't one we are looking to buy now. We want to look at growth companies, and the first one here is Alphabet. We have spoken about this company in quite some detail just over the last few weeks. Over the last year, it has performed very strongly. Over the last 10 years, it has massively outperformed the S&P. Not something we could say for either Hershey or Mondelez, although do bear in mind something we also understand, that past performance is not an indicator of the future performance. And when we take a look at their growth grade, they do get a B, although more specifically in terms of the earnings per share, not only very strong at around 17%, but that is also higher than what we can see here as the sector median of 11%. On top of that, if you just want to take a very quick look at what the analysts see, they believe Google will hit around $212 over the next 12 months, and that is near around the 20% upside. As always though, this isn't something we tend to rely on, it is just something we include to wrap up our overall analysis, and we can say with the Hershey company, this isn't something we saw. In fact, Wall Street did believe this was trading right now at its price that it will hit in around 1 year's time. Then we move to the other company, again one we have spoken about, ASML. Whilst performing fairly poorly over the last 12 months, over the last 10 years, massive outperformance of the S&P 500. Right now, it is trading towards its 52-week lows, and if we similarly look at the growth grade, they do get a B. In fact, when we look at the earnings per share, around 17.4%, marginally higher than the sector median of 16. Again, these were things we couldn't say with the other two companies. And if we do conclude by taking a look at their share price, it is estimated to be around $882 with around 24% upside. Again, these are things we just use as part of our overall analysis. We're not buying or selling based on what Wall Street say, based on what the institutions, but what we have started to do is look at a portfolio that has more growth in it rather than companies like Hershey in particular that is starting to look to decline. Now, all these companies are still very strong. Different investors will have different investment horizons, different strategies. So we're not saying any of these should be a buy, any of these should be a sell, and always do your own due diligence. We would, however, like to know your thoughts in the comments below, whether you agree with this, whether you disagree, or in fact, if you've been buying or selling any other company. As always though, if you did enjoy the episode, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter below, pick up those spreadsheets, and come and join us on the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.